the second phase of this morning's session on the first day of TradeTech. I'm very pleased to introduce Alain Bocobza, Head of Global Asset Allocation at SocGen, who's going to talk to us about the outlook for equity returns and are we starting to see real value. So I welcome Alain to the stage.
Talking about return for financial markets, we need to be very precise about the way we are looking on a global basis and also on a cross-asset basis, as sometimes in history, when we have had abnormal returns, whether very positive or very negative, on the equity market, this was due to features outside the equity market themselves. So I will deal with a few key points through this presentation, and the key driver will be just one idea. One idea being that higher growth, one might expect in the USA or the UK, is going to lead to lower expected returns for financial assets, including equities. And in regions like EM, where you do have slower growth, you are going to have higher expected returns. I'm going to build the equity market prospects through this angle today. If you look at the first point on emerging markets, the peak point in the expectations and the valuation for emerging assets was not when the Fed announced taper last year, but was back when China, in the last quarter of 2010, announced that they were on the eve of policy tightening, the monetary policy and the fiscal policy. Since then, the EM party is over. 3 years of underperformance. Since then, you have had a significant downgrade of growth expectation from consensus economists. Remember back in early 2011, they were talking to all of us with decoupling, growth forever without problem. At a time when for developed markets, we were talking about no growth and fears of deflation. But you see on the three graphs in the bottom, you now have significant downgrades which have come. Nobody anymore is talking about decoupling. And I start to read some people who were talking 3 years ago about the decoupling idea, the same economists talking to us on the market with the lost decade. This I just love. Also, when you look at the most imbalanced countries in emerging are capable to destabilize the recovery you have in the USA or the UK, and they are able, if they were to switch very sour, they are also able to destabilize the nascent recovery of the Eurozone. So it is very important to qualify and quantify the policy reaction from the most imbalanced emerging countries. From up to bottom, you have the percentage change of the currency vis-à-vis the US dollar since the Fed announced taper in May last year. And from left to right, you have the policy reaction. On the right and bottom, you have the bad boys, all the countries which made too much growth, but very imbalanced growth. Brazil, Turkey, Indonesia, Russia, South Africa, India. All these are very, very, very imbalanced countries, from twin deficits to inflation, and sometimes no more competitivity after no reform in the last 10 or 15 years. Policy reaction came in the end with two angles. One, countries which have far away elections. By the end of this year, you will have an election in Brazil. Nobody can expect populist governments to implement any structural reform by then. The only answer is the central banker significantly raising the cost of shorting the currency, and that is called central bank rates going through the roof. Thanks, you have a very good policy reaction. That is a kind of Valium, you take your pill, waiting for structural reform to happen after an election. The template in EM is to be found in India. Last year, since May, you had a catastrophe on all Indian assets, more than 20% fall on the rupee. And since November, you have polls indicating for the April-May election, a pro-business, pro-entrepreneur, charismatic individual, Mr. Modi is going to win the election. Then after the election, you have a prospect of structural reforms, and the central banker has only to do 50 bips. That is the template for all these imbalanced countries, but you have an election trade which happens a few months prior to the election and the confirmation after. That is a very important feature, that there is a policy reaction for all these imbalanced countries to better manage on a macro picture. The other feature is probably in this room, you would all share the view that the biggest risk on this planet is a China hard landing. If that is true, why? A country with $3,500 billion of reserves, with no more inflation, and an underleverage from the sovereign standpoint, why should they allow to go under? They have already, top right, stopped the appreciation of the currency. And last night in the US, you had the first attack from the US Treasury saying, China, please don't play with your currency. In the pipeline, they are trying to stop the appreciation. That's already done. But they will try without any doubt to play competitive devaluation. There is only one way for a country which has lost its competitiveness on the currency side. Also, what you have on the left is the way the China Central Bank, the PBOC in Beijing, has worked on the tightening. They are not working on rates, but they are working on what they call the reserve requirement ratio. That is the credit distribution, which was tightened a lot, from 7% a few years ago to 20%. 20% of the capital of Chinese banks is tied with a minimal remuneration at the central bank. In the pipeline, you will have policy loosening to avoid a catastrophe, which everybody sees as obvious. We disagree. And also, you had insights in the last few days. It is a very recent feature that they do allow for infrastructure spending to come to alleviate the fear of a hard landing. That is very important for all the emerging countries, which are one way or the other very much linked to China growth. We are market players. We don't invest in markets ahead of a significant currency risk, do we? When you're doing global, you need to monitor what is your currency risk. That is a basket of emerging currencies against the US dollar. A basket which includes some LATAM, some Central and Eastern Europe, and some Asian currencies. Most market participants only view the fall of these currencies since the Fed announced taper May last year. We disagree. The big picture is that these currencies started to collapse in March 2011. The empathy was over since then when China started to decelerate. In that sense, we are back where we were before the Fed started currency war. Remember, when the Fed was doing QE1, QE2, some emerging countries were complaining that the US Federal Reserve was playing down their currency, which was right. We are back to all-time lows on emerging currencies on aggregate. Wow, that is a perfect territory to start investing. When the market is saying lost decade, when the assets are already very low. You see also on the right the blue line, which shows the local currency bond spread against the US Treasury, against the bond market in the US. The spread has reappeared. We find that for bond players, there is no value you hadn't for years in emerging bonds. You have carry. You have yield in a world which is still striving for yield. The concept of emerging equity markets is basically very simple. 2/3 of emerging equities is EM Asia. 17% emerging Europe, 19% in LATAM equity markets. If you get right the prospects of EM Asia, you will get right the prospects for EM equity exposure. There is one very simple graph which highlights that Asia, as a whole, it would be very similar for the Eurozone. Asia is a region which is structurally linked with US growth. When the brown line goes up, when the US PMIs are going up, a leading indicator of the US economy goes up, then Asian equity markets go up. The link is obviously the two economies are strongly linked. With the backing we saw earlier that China does not go into hard landing. In early 2011, when consensus economists were talking to us on the market, decoupling was their message. At that period, emerging equity markets were trading at a 20% premium valuation to developed equities, the highest ever. Premium valuation for an asset which is not that tradable. Why should you trade so expensively an asset which structurally is not tradable, at least compared to the S&P or the DAX? We highlighted in those times that an asset priced for perfection, the story behind it was decoupling. There was an asymmetry in the price profile, where price for perfection with a premium valuation, with a decoupling idea, had only an asymmetry and downgrades in the pipeline. Now you have a 30% discount, and the discount is mainly to be found in BRIC against non-BRIC against the frontier markets. The BRIC equity market have been hammered in the last 4 years. This is where I would recommend investing. This is where the economic story is under attack by economists. When a few years ago, when you were trading at 20% premium valuation, they were telling us that it was the place to invest. We have to be contrarian here. One market we love is China. China was the only equity market to go up in the last few weeks, the only one. On the left, you have, since 1994, the China equity market valuation, rock bottom, what we call value. You may have seen in NASDAQ a switch out of super growth, super expensive cloud computing stocks, biotech stocks, into boring old technology stocks like Microsoft and Apple computers. A switch from growth into value, but into value, when you apply this within the EM space, is China. On the right, there is China banks bashing in the market. They are trading at a 40% discount to an already heavily discounted market. But just a dream for the value players, ahead of a monetary policy loosening. To put into perspective, the US equity index multiplied by 3 since Lehman Brothers broke down, and you just had bashing against the China equity market. It's one of the biggest in the world in market cap, and it's going to open up to foreigners. The reforms we have been listening in December last year from the China new leaders, definitely they want to open up the currency, the bonds, and the domestic equity market. You have so many blue chips where the market cap is from $100 to $150 billion market cap into that market, and it is going to open up to foreigners. Why would you chase the very expensive S&P? So I like EM. I like to be contrarian, as I liked back in March 2011 to print the EM party was over. In the US, there is only one direction. Stronger growth, which is around. The market was complaining about 200,000 employment creation per month. We are here in Paris, in France. If you were to go into Italy, into Spain, into many of the emerging countries, that would be a terribly fast speed for employment creation. The market is very, very demanding for the US. But the communication we had from the Fed is very clear. Normalization of economic conditions will lead to normalization of inflation expectations. The Fed has to do taper is tightening. And what you have here, the blue line highlights the Fed funds, the risk-free for global markets, whatever you are investing in, whether it is on real asset, whether it is on implied asset like volatility or correlation of dividends, whatever you invest in. You need to be aware that the Fed funds are going to rise from next year. The blue line is currently 0. The brown line is an econometric model we use intensively. We have a 5-year forecast on the Fed funds, and we give you the backtrack. Just academic work applied to the most important asset for financial market players we are, which is the Fed funds. The Fed, after Lehman Brothers broke down, should have been minus 8% on the Fed fund. Should have been minus 8. Zero rate were not enough. They invented quantitative easing. Money creation, the Fed quadrupled the size of its balance sheet since then. But you see that since then, economic conditions have normalized. Unemployment has collapsed. And inflation expectation will start to rise. And that is why we print here that in an academic way, the Fed should already have gone out of zero rate. When the Fed is supposed to exit mid-2015, the zero rate policy, the Fed would be behind the curve by something like 300 basis points. Wow. The Fed is pushing, expect growth to continue to accelerate. Because they are behind the curve, this is what they want, to be sure that economic conditions continue to be very good. To make money out of that is not easy for US assets. As higher growth leads to monetary policy tightening, liquidity conditions are going to tighten. How do you make money out of that? The only way to avoid a bond market crash on the eve of acceleration and inflation expectations gradually normalizing from deflation fears is for the Fed to hike interest rates. We show here the spread between short-term rates and 10-year rates, between the bond market and the expectation of what the Fed is going to do. And every time the Fed tightens, when the short-term rates go up, you have a process of flattening of the yield curve. Short-term rates go up quicker than the long-term rates. The only way for the Federal Reserve to avoid a catastrophe on the bond market, a 1994 type scenario, is to start hiking the rate. I would see that as a very, very good move from the Fed when they do it. Some will complain that the Fed is taking some liquidity out of the markets. Indeed, they do. But if that prevents a bond market crash, I think that will be a good job from the Federal Reserve. Through the flattening of the process from an extremely steepened curve you have at the moment. Some say the dollar is extremely cheap against an extremely expensive euro. We disagree. If you say that is the purchasing power parity, these are long-term valuation tools. Purchasing power parity, you see, structurally falls. That means you have more inflation, less productivity gains in the US than you have in the Eurozone. So the PPP, the fair value of the euro dollar, structurally goes against the US dollar. Currently, it's around 130, and the euro is around 140. Nobody can say that the problem of the euro area is the currency. That is why some have been waiting for the bazooka response from the ECB for so long, because the analysis we have and the analysis they have in Frankfurt at the ECB is that the problem of the Eurozone, there are so many problems, but it is not the currency itself. So we expect somewhat of a weaker, a stronger US dollar when they start tightening, because you have a higher remuneration on fixed income asset in the US, but it will not be a collapse of the euro when it comes. When you have higher short-term rates, higher long-term rates, gradually stronger currency, that is a headwind for the competitivity of the US economy, how could one expect the US equity valuation will act shorter term, that is dating back to 1881? How could one expect the US equity valuation to continue to expand? The time to buy US equities was after the catastrophe and when the Fed started QE1, when it was extremely cheap. Today, we are close to the end of the bull market. I'm not saying we are on the eve of a bear market, but after 5 years of astonishing rise of the US equities, I think one should switch from long only to long short on their strategy on US equities to make money. This is the path for Japan inflation. If you exclude the economic error and the lie by Prime Minister Abe, remember he had 3 promises in his economic policy. One was competitive devaluation, killing the yen. The other one was fiscal stimulus, and the third one was the structural reforms. We're still waiting for structural reforms, and he didn't do fiscal stimulus, but the consumer tax increase is something like 2% of GDP. Fiscal tightening. He's a liar. Markets don't like liars in politics, do they? If you try and explain why Nikkei fell so significantly since the announcement that they are going to introduce fiscal tightening. And one area in which we insist a lot is on the fact that if you exclude the consumer tax increase impact on the inflation regime, then underlying inflation will stay under 2% by the end of 2016. It means the Bank of Japan has a license to print, as their target is to be structurally above 2% inflation. And whenever the Bank of Japan prints, it sends the yen down. And we all know too much that the yen down is better competitivity for Japan corporations, and then Nikkei goes up. We just lack what they call arrow number 1 in Abenomics, which is the playing with the currency and doing everything possible through the monetary policy to send that currency down and down and down. Overall, we don't like Abenomics because he's not powerful enough to implement what he said. Last chapter is Europe. I was arguing a few quarters ago, when you had such a gap between optimism you had when you went to New York, meeting our asset managers, we have a big office in New York. They were like a big bull. You know, everything is good in the US. Growth is coming back. Property market is rising in double-digit figures. And compared to that, so the 3% growth for the next 2 or 3 years, and you had the bashing in Europe as if the 2 regions were not linked. So we have insisted a lot on the graph on the left, showing that in history, never, and here starts in 1980, but we could come back since 1984, since World War II, never, I repeat, never, we have seen a US recovery without triggering with it Europe. Maybe with 1 or 2 quarters lag. But systematically, When you have a US economic recovery, Europe follows, a bit like some Asian countries. And this was discriminant for the recuperation of European equity markets, if not the Eurozone equity markets, because this is where the bashing was the biggest. And you see that compared to what you have seen in the latter years, which was a significant downgrade in economic forecasting, the consequence of very bad governance, you don't have upgrades which are starting for 2014 and 2015, a new feature. Europe always follows the US. One cannot be super optimistic about US growth prospects and the European bashing, at least on GDP growth forecast. We can do on governance, we can't on GDP forecast. The most important argument for those who are doing bashing against Europe comes from the financial conditions, saying how can you grow in the Eurozone with financial conditions so tight? And you have better news coming. We read this morning into the Financial Times that Greece is going to open up the first issuance of government bonds in the next few days with rates under 6%. Rates are 12% in Brazil today. And what you have here, with the acceleration of the fall of the spread between the peripheral yields and the benchmark bond yield in Germany, is that the more you have trouble in some imbalanced countries in EM, the more you have the spread compression, because you have a reallocation out of EM into the Eurozone, where you do have yield. In a few months' time, gilt yields will be above the peripheral yields. UK fund managers who do manage a significant amount of European money will have to be forced to switch out of the UK and to go into peripheral Europe. SMEs, non-quoted companies, used to finance at a significant interest rate premium, non-quoted companies. They were just killed by the lack of available capital at a reasonable pricing. And you see that SME rate financing is currently collapsing. The work being done by the ECB is significantly impacting positively more than the market sees. The other feature, on a global basis, a very simple asset allocation tool. When you want to protect from the US assets, which are burdened by the policy tightening we explained earlier, where do you go? To capture US growth. Whenever the US Federal Reserve tightens, then better be in Eurozone equities against US equities. Global fund managers would switch into the Eurozone. They have probably started to do it. As markets are efficient, the Fed has already announced they are going to tighten next year. The underlying idea is the profit recovery. With so many countries in the Eurozone working on their competitivity at the moment, it means tomorrow the damaged profitability you see on the left in blue, you have the first ever huge gap between the reported earnings by European corporation and the reported earnings by quoted US corporation. That gap is going to be filled in the next few hours, in the next 2 or 3 years. The impact of better competitivity is obviously better corporate profitability tomorrow. The last feature is the Eurozone crisis. If we want to highlight the big picture and say, if the governance of countries has improved to work on competitivity, how is the banking sector? As the Eurozone sovereign crisis was also a banking crisis. What we call the comprehensive review is basically 2 ideas. One, the supervision of banks has been transferred to the European Central Bank. It's not national supervisor who can cheat with the accounts. It is in Frankfurt with an independent body. No bank being supervised by the ECB can escape opening the books. All the banks who have cheated with the market will be forced to recapitalize. Secondly, you have a process in which by the end of this year, all the weaker banks will be recapitalized. That is the speed at which the ECB goes, with Oliver Wyman as a consultant, an external consultant. They are doing the job at a very fast speed. Many banks have already announced CoCos. Many banks have already announced right issues. Many banks have announced asset sales in order to be ready for the asset quality review and the stress test, which will follow. Banks have started to outperform in the Eurozone, a market which itself is outperforming. We are all in Paris today. We are all heavy travelers. And today, in the French Parliament, you are going to have the new economic policy confirmed by the new Prime Minister. If you do remember, mid-January this year, you had an announcement that France was shifting from bad policies, bad macro policies France has implemented in the last 30 years, deficits, growing debt, inflation, devaluations, into supply-side policy. Mid-January was announced two key ideas: 30 billion, cut in corporate taxation, financed by 50 billion, cut in spending in 3 years. 50 billion in 3 years might look gigantic as a number. If you say 15 billion per year, France is a 2,000 billion euro economy that makes 0.8% of GDP per year. For a champion of fiscal spending, to go 0.8% of GDP per year is not that speedy. It is achievable. The change in economic policy will lead to one of our major calls for the next 2 or 3 years, which is after 15 years of huge underperformance of the CAC 40 against the DAX German index, you are going to have a spectacular rise, maybe a doubling of the equity index in the next 2 or 3 years. Thank you very much.
Thank you, Alain. Okay, over to the audience. Any questions, please? Any hands going up? No, okay. What for you is one of the top issues, like the number one thing that would keep you awake at night, for example, in terms of the outlook for the European economy and the equities market within that?
In fact, I'm looking for momentum. That means new news, because the ones who were short the Eurozone in bonds and equities have closed their shorts, so that's done. And that happened since, I would say, summer 2013. So where you can have surprise to current expectation is in the two countries which are lagging the restructuring, namely Italy and France, which are the lagging, no competitivity in those two countries. And the market does not believe that the execution of the plans to go back into competitivity will materialize. This is why we emphasize a lot today's speech in Parliament with the new Prime Minister in France, as he could be right-wing in the wording of French politics. And he has the means to execute much faster than current market expectation. And for Italy, Prime Minister Renzi is working on a new political framework, a new electoral law, which, when and if put in place, we believe by summer, we believe that that would allow a fast track for reforms. That is one. So the two weaker countries are where the risk lies today. It is not anymore in Spain. It is not, but it is in the lagging countries. The other feature is the political analysis of what Germany is doing. Germany has switched into grand coalition, and the top priority in economic terms of this grand coalition is switching into renewables, financed by quoted corporation, quoted in the DAX. RWE and E.ON are being asked to finance tens of billions of euros going into renewables and stopping very profitable nuclear business. That is very high cost to German competitivity. And also, the Grand Coalition goes into more redistribution, wage growth, minimum wage. That is what we have been waiting for Germany for the last 15 years. Yeah, to put its surplus, its savings back at work and consume. This is what they are currently doing. And this will help the rest of Europe.
Mm-hmm.
Yeah?
Okay.
So you have both sides of the equation which are currently working. Very slowly, obviously always too slow for the market, but the trend is set in Germany that they're spending the surpluses and this will help the rest of Europe.
Mm-hmm.
This is why we hate the tax.
Indeed. Any questions from the audience? Yeah.
Dan Barnes, freelance journalist. Do you have any concerns about the level of corporate governance in China being weak enough to facilitate a major crash there?
For all those who invest in emerging countries on equity markets, they have a governance problem. There has been a tremendous improvement in the governance in the developed quoted equity markets. We have private equity on which we could ask the question, but for quoted developed equity market, the governance has improved a lot, but not for EM. So you could ask for China, you could ask for Brazil, you could ask for Russia, governance and Russian quoted corporation. So you could take China off, put Russia, put Brazil, put India, all the emerging countries when you are talking about quoted equities have a low governance level. It's not particular, specific to China. But back to your question, we know that corporate leverage is huge in EM, in China also. So we all know that if you have fought inflation, which they did in China, yeah, they started to slow down the economy back in Q4 2010, remember? That the policy change happened more than 3 years ago already, close to 3.5 years. And they have successfully slowed down the economy early, before the problems. They have won the fight against inflation. And to help this over-leverage, not ending up in a catastrophe, this is our proposal that why would this very rich country allow for a catastrophe? They will allow some companies which cannot be viable to go and make bankruptcy. You had 3 weeks ago a solar panel manufacturer going bust. For those who know that sector globally, there were 2 countries which were building solar panel manufacturing. That was Germany and China. 4 years ago, the German producers went bust. And when they went bust, they were saying the entire global industry for solar panel manufacturer is bankrupt. We knew 4 years ago that they were bankrupt. So it was no news that day. You had on the headline of economic news, wow, it is a major fear. That date, on the credit market, the corporate bond market in China, that date the market went up. It was no news to anybody on the market level.
Thank you very much, Alain, for that fascinating talk. You can stand up there.